All right. Everybody, welcome. My name is Vickie Gibbs, and I am the Executive Director for the Entrepreneurship Center here at UNC Kenan-Flagler. And I have with me today a very special guest and friend, Rodney Sampson. And Rodney is a man of many talents. He is a man of many hats. He has been a successful founder. He is an investor. He is a GP as well as an LP. He is an ecosystem builder. And I'm most excited because we also have the great honor of calling him a partner. The Entrepreneurship Center and OHUB, one of his businesses, have partnered to bring two certificate programs to everyone. And we covered one of those, took a little bit deeper dive in that on Tuesday, talking about the Deus Practicum and how companies move from performative statements to actually truly integrating DEI into their organization and moving to a place of impact as opposed to just talk. And one of the things that came up on Tuesday was another really meaty subject, meaty problem to solve, which is closing the wealth gap. And we're going to really double click on that today. But would love, Rodney, could you please just give a little bit of your background and introduce yourself to our audience as we get started here?
Sure thing. Thank you, Vickie. And hey, everybody, welcome to class. This is a preview of what we will be doing in the fall. So really excited about our partnership with the Eship Center at UNC Kenan-Flagler. A little bit about my background. So I am a native of Atlanta, Georgia. My formal education was at Tulane University in New Orleans, Pennsylvania State University College of Medicine. That's another rabbit hole we can talk about another day. And Keller Graduate School of Management. In 2000, I started my first technology startup. And some would say that our company, Multicast Media Technologies, we were amongst a small group of pioneers in the streaming software technologies space, streaming media space over 20 years ago. And I can remember having conversations with people that there will come a time, didn't know when, didn't know where, that streaming would be required if you wanted to deliver a message or deliver content. And we saw that last year. My phone last March and April was ringing off the hook, and people were like, you told us, you said this. Oh, I'm ready to get going now. I was like, oh, that company was sold in 2010. So I'm out of the space, but I am actually cooking some things up. I've always got, Vickie knows this, once a founder, always a founder. So I've got some things I'm cooking up in the streaming space, because that was really my first love as it relates to the technology ecosystem, was those early days of being a founder. A little bit of history, which is contextual to the conversation we're having today and why we are doing this certificate. So in 2000, I was the first Black co-founder of a technology startup company that raised over $1 million in venture capital. And I was the first in the South, rather. And there were three of us back in those days, in that era. Clarence Wooten, who was in Baltimore, he had raised more than all of us. He raised over 20 million. We raised collectively about 4. And then there was Omar Wasso. Many of you might know him as the founder of Black Planet. Today, he's a professor of the practice. He actually might be a tenured professor at Princeton, actually. But one of his largest investors was actually Steve Case at AOL back in the day, as we say it. And we all had a mentor from afar by the name of Emmett McHenry. Emmett is now a venture partner in our venture fund, 100 Black Angels and Allies. But Emmett was the original founder of Network Solutions. And I want to come back to Emmett in a second, because it provides context to really why we are doing this program. So for the first 10 years of my career, I was that founder. I was like many startup founders out there trying to really figure it out. There weren't as many accelerators or incubators or entrepreneurship support programs. No one was talking about DAIS, diversity, equity, and inclusion solutions for the startup ecosystem. My colleague and friend, Brad Feld, shameless plug, we have a new podcast together called Equity District. So check it out. Brad Feld hadn't written his thesis on building startup communities yet. And so, this ecosystem was sort of like shapeless and unformed. It hadn't really come together, Vickie. But the first 10 years, were building companies. 4 technology companies, 2 were incredible failures, not because they weren't good businesses, but because of the timing and because of policy and legislation, all the things that can impact a company when you believe you have a big idea that can solve a big problem. But lo and behold, 2 of them were successful. And so Multicast Media Technologies was acquired, and eFactor was acquired. And so 4 companies, 2 exits. I was sort of burnt out from company building. Company building can take a lot out of you. It's a very, very lonely space building a company, especially a high growth company, where it sometimes feels like you're on a rocket ship holding it together, building it in the air. And so I took a break and actually got more involved in my community, my church, and I reconnected with an early mentor of mine by the name of Dr. John Maxwell. And Dr. Maxwell, if you know of his work in leadership, invited me to be a part of this program he was doing in Africa called Equip. And so I went to Namibia. I commuted back and forth for 3 years, and I was a part of a program that was a train-the-trainer program that ultimately trained over 30,000 people in values-based leadership. So while commuting back and forth, I started writing. And so in the span of 3 or 4 years, I published 4 books. And then in 2012, I released, actually it was on my birthday, I released Kingonomics, 12 Innovative Currencies for Transforming Your Business and Life, inspired by Dr. Martin Luther King Jr. And the published date was my birthday, which is December 25th, but it didn't drop to the public until King Week of 2013, which is when we launched the first Kingonomics conference, which literally became sort of the framework for Opportunity Hub. We used Kingonomics as our customer discovery. At the time, I was leading DAIS for Mark Burnett Productions and Hearst. And Shark Tank is one of their shows. And so we helped to create the minority casting calls for Shark Tank that now values partnerships, and Brandon Andrews continues to this day. And we worked on a few other properties. I even had we had a few conversations about the Celebrity Apprentice. They should have listened to me. I'll say that. They should have listened to me in that period of time. But I enjoyed that. And so Opportunity Hub was born in 2013 as well. And our stories on our website, I won't bore you with that. And so I sort of evolved from, founder to ecosystem developer to investor as well. And a little bit about my investment background, since that's what we're talking about today, is I am a limited partner. I'll tell you a little bit about what that is a little later, in 6 venture funds. That a limited partner is an investor. Why wait? So I'm an investor in about 6 venture funds. I'm also a direct investor in about 30 other companies. And so I've been investing professionally since 2010. So, if you're going to listen to someone about investing in this asset class, you definitely want to talk to someone who is investing in the asset class and over indexes in our thesis, which is investing in Black funds and Black founders. Specifically. I'm also a non-resident senior fellow at the Brookings Institution. Serve on a few nonprofit boards like Artificial Intelligence for All, AI for All, Black and AI, the Multicultural Media, Telecom, and Internet Council out of DC, the International Bishops Conference. And I'm a member of Omega Psi Phi Fraternity Incorporated. So
that's quite the list, Rodney. Well, and I think one of the things that just I think your life and your career really depicts is that there's a lot of big problems to solve, and we can't solve them by ourselves. We have to work together to solve these problems, but it also takes multifaceted approach, right?
right.
You've done a lot of work just on the ecosystem side with how these different things fit together. And I would love for you to talk a little bit about, kind of zooming out, like some of the work that y'all have done with equity districts, but then also your 100 Black Angels and Allies that started out as 100 Black Angels. And so would love for you to hit on both of those and sort of give the audience some context with what are all the moving pieces that need to happen to, solve major problems like closing the wealth gap.
Absolutely. So equity district is really a framework and kind of concept out of us doing this ecosystem development work for over 8 years. A lot of ecosystem building organizations have struggled to find sustainable business models and have relied on philanthropy or corporate sponsorships. Most of us have tried co-working, some successfully, some unsuccessfully, and really struggle to find a business model that works for ecosystem development. And just, doing what founders do and continuously pivoting and adding programs and doing the work, we really discover first a framework that we signaled out in collaboration with Dr. Dale Gines and the Federal Reserve Bank of Kansas City on an economic development pyramid. Is kind of the infographic of how to build inclusive innovation, entrepreneurship, and investment communities in communities of color. It's one thing for us to integrate into existing frameworks of innovation and entrepreneurship and investment, which is important as it relates to creating, racial equity there. But there's also like the Dame and John model of FUBU, the for us, by us as well. And so we developed that framework, we signaled it out through Brookings. And I started having, a lot of conversations, getting invited to the table to be a part of helping to structure the governance of innovation districts. Mm-hmm. And what I realized when I started doing my deep dive on innovation districts, Vickie, is that the innovation density that the districts can create are not good for Black people and brown people, poor people. And there's, intersectionality there, of course. One of the reasons we're doing this course is all Black and brown people aren't poor, right? There are accredited investors, or there are wealthy, high net worth individuals in each of those respective demographics. So, a lot of times the work is centered around only looking at people through the lens of poverty. And you might be, having a conversation with a millionaire or someone who grew up in a middle-class household and not, the proverbial ghetto, or the hood or what have you. Now, mind you, we all are one step away from a hood. I don't care if you're white or Black, some hood folk, just to keep it real, right. In your community and in your network. But so we took our framework from the Federal Reserve Bank and we took the programs that we had seen success with. Mm-hmm. And we're like, if we could put those programs into one model and figure out the funding structure, everything from early exposure to education and training, to career placements, to startup programs, innovation programs, investment, capital formation, and access to markets, which all of those things have formidable business models. And what I've encouraged Black ecosystem builders, which is one of the reasons we framed the name of this particular certificate around Black technology ecosystem investment, is that we have too many minority-focused ecosystems that are steered towards being nonprofits. Whereas if you look at our counterparts in the mainstream ecosystem, they're all for-profit concerns. And so I fundamentally take issue with Black people having to do this work and it always be nonprofit, where our white peers or non-Black peers can do the work and they're able to generate profits and maybe even create wealth. So we present the ecosystem as an investment class. And there are different points in the ecosystem that you can invest. And it's important to get this right because, you know, we have the Frontiers Act, you know, that made it through the Senate. We're about to see America embark upon this $250 billion proposal that probably will get through the House and it will get to the president's desk, and co-sponsored by Congressman Ro Khanna out of Silicon Valley. I spent a year plus helping him kind of shape some of the equity and inclusion parts of that. And it, you know, doesn't always get translated exactly like we want it to, but it's kind of baked in there. And hopefully when it gets to the House, we'll be able to kind of reiterate some things related to the importance of investing in the Black tech ecosystem as a part of this Frontiers Act. So you're going to have 18 regions in the United States split up $250 billion, right? And then you're going to have this huge infrastructure bill as well. So we're about to see the reset, the re-innovation, the rebuilding per se of America for the fourth industrial revolution. And when I look at it, when I talk to my peers, when I talk to those who have been investing in this asset class and making investments for years now, I don't see enough of my Black community in the asset class that has, you know, created disproportionately economic freedom and wealth for others in this country. Now, some of it's because we don't have exposure, some of it's because we right now are not invited and have been denied access. And so through our work, we're hacking that just a little bit. So I took a little bit longer today to give you context around these frameworks, a little bit about my personal background, and also a little bit about the macro framework of how we approach ecosystem development. And then for today, why this particular certificate around capital formation is important.
Great. And I want to double click on that a little bit. So, because again, lots of different pieces to the puzzle. And so when you talk about investment, there's two sides to that, right? So the first one, let's talk about that capital formation, right? So you talked about, you know, targeting and getting Black and brown men and women educated around how to invest in startups, in Black and brown founders, right? So how does one go about that? There's, of course, they need to be accredited, but then what are the types of things that, you know, is going to make someone feel comfortable and excited about investing in this class, and how are you addressing that?
Absolutely. So I like to start this contest because, you know, for every push to get more Black and brown folks into the asset class, there's a counter push to say, well, everything is not tech and everything is not venture, and we shouldn't be relying on venture. And I think a lot of it is because people sometimes, you know, candidly badmouth what they haven't been able to access. And then those of us who unfortunately are outliers, it's not anything to really brag on. You are, you know, one of the outliers that raised capital, one of the outliers that raised the fund. But because you have that exposure and that experience, you've kind of seen a little bit of the light. But, you know, when you look at this from a macro perspective, and on our workshop on Tuesday, we'll have David back in the fall. David Wills, former vice chairman of NASDAQ. He's a member of our advisory board. He's a partner with us on Deus. We're actually turning Deus into a company now. We just made an offer to a CEO to help us build it. So we're working over here. Bootstrapping and still building. So, you know, contextually, venture capital is only representing a little, you know, less than 3% of all the capital that's invested in America. But that capital is going into high growth companies, mostly tech startups, that are responsible for the majority of net new jobs, you know, in this nation. And I'm gonna drop a few links, and so that might cause a slight pause. You know, folks don't believe nothing unless it's on the web. So that's one source. There are other sources that show the number of jobs created by startup businesses. Even in 2020, okay, when 39% at the beginning of the pandemic, 39%, according to McKinsey, of Black Americans were unemployed, and 41% of our businesses shuttered. Vickie, 3.1 million new jobs were created in 2020 by startups, right? So like there is work in the startup ecosystem, and all of the roles aren't engineers. There's sales roles, there's finance roles, there's ops roles, there's, planning, strategy. There are all types of roles, impact roles as well in the startup ecosystem. And so the reason we've chosen to kind of, build on this hill in particular, some people are building on the CDFI hill. Absolutely, I get it, for Main Street businesses. Some people are building on the debt, Black banks getting access to capital. And we applaud the efforts of like First Boulevard and others that are building there. We're building here unapologetically because we see venture capital to the tune in 2019 was 131 billion. In 2020, I'm seeing two kind of reports. National Venture Capital Association, I think, was projecting about 156. I saw something on Crunchbase that said 300 billion, so it has grown exponentially in the pandemic year. That capital is fueling edge technology companies that are really responsible for now 60% of net new jobs in our country. And so if you want to even start talking about, narrowing the wealth gap, to close it, I wanted to drop a link in here just to give you some context from Brookings here. And you can really, put some numbers to some of this stuff. So, when we hear people like launch $100 million initiative and say, together we'll close the racial wealth gap. Nah, you might narrow it just a little bit. So even when you hear like a bank, making a 4-year $1 billion, commitment, well, that's $250 million. They made 30 billion last year in banking fees off of poor people, so I'm not really impressed with the statements compared to looking at the other side of the data. So, but I wanted you to really look at, and Brookings did a really good job at kind of contextualizing what that number is to actually close the racial wealth gap. But what we can do, and what we aim to do in OHUB and through our universe of work, is closing that wealth gap for a family and a person one by one. So you can do it, that's what keeps us excited. And so when you look at the asset class, and we really shouldn't be talking about this asset class without talking about the definition of accreditation. It's a class, so you all can work, and then we're going to have someone from the SEC come in the fall, and talk about this. But I'm going to drop the new modernized definitions of an accredited investor. Before August 26th of last year, to be an accredited investor and to access, what we call the deal flow in the startup ecosystem, you had to be an accredited investor, meaning you had a net worth of $1 million plus that did not include your personal property. Before Dodd-Frank bill was passed, it could include your personal property. That was one of the disappointments I had with Dodd-Frank, was that now it has to exclude your personal property. And a lot of African Americans, just like a lot of Americans, their wealth is in their home. And so you were excluded from participating in the asset class, one, because Dodd-Frank eliminated it, but also Dodd-Frank was a response to the 2008 economic downturn, where a lot of communities lost equity in their houses anyway, especially in Black communities that were over redline. And so we lost wealth, and then we lost the ability to actually be an investor. The other definition of an accredited investor was that you had an annual salary of $200,000 as an individual for at least 2 years, for a recurring 2 years, and as a couple, $300,000. So these would be your corporate professionals, VP levels and up, um, successful doctors, lawyers, some pastors, of course, entertainers, college presidents. So what we realized, and there was another infographic that we refer to, we'll pull it out in the course in the slides, but that approximately 1 to 2%, depending on how you look at the data, 1 to 2% of Black Americans were accredited. Of course, everything I said before that applies. A lot of that is in-house, where there's not liquidity. But we often have asked the question, where are the Black investors? And so we know they are out there. Now, some would say, well, you don't have to be accredited to invest in startups. You absolutely don't, because of the 2012 Jumpstart Our Business Startups Act, which of course, David was one of the godfathers of that act. I was a huge advocate for. And so we've seen a lot more startups raise their pre-seed and seed rounds through equity crowdfunding. And that is an incredible way to own small amounts of the companies that you want to back and to bet on. However, if you want to invest in venture funds, which give you sort of a pro rata distribution across 30 to 40 companies at one time versus one company, you have to be accredited. Venture funds do not or cannot allow for non-accredited investors. And then you have what's called the rule of 99. You can only have 99 investors in a fund, which is why our fund is called 100 Black Angels and Allies. One, because, my wife and I were the first investors. So we were one, and then we can get 99 more. And so, understanding this framework is incredibly important. Go ahead, Vickie.
I was going to say, I wanted to make a point to the audience too, is that you brought up a really good point, because there have been some changes in the SEC, both regarding how do you qualify an accredited investor. And one of the things they added is that you could take certification courses, right? So that's something that the education side is really important, so that you understand the risk that you're entering into. And there's also been alterations to the crowdfunding. Arlen Hamilton with Backstage Capital, she actually grew her most recent fund up because they changed that you could do up to $5 million in crowdfunding. And so those changes are actually enabling more people to get involved, across the board, but also specifically Black and brown men and women. The other thing is that crowdfunding and VC, it has different multiples. So when you talk about closing the wealth gap, crowdfunding may return, 1.5 to 3 times, but a VC fund may return 10 times or more, right? And so you're talking about, if you're really trying to impact the generational wealth of a particular family or a particular founder, those large sums are really impactful. So you started to I wanted to take a brief and sort of level set on a couple of those things, but would love for you to tell a little bit about, so you and your wife were the first investors. Talk a little bit about 100 Black Angels and Allies, because y'all started that last year, after the murder of George Floyd and everything that happened last year. But then you had some people who maybe you didn't expect to become interested as well. And y'all modified that. Y'all touched on this in your Juneteenth presentation, but I would love for you to hit on that again here.
Absolutely. So a little bit about what led up to 100 Black Angels and then 100 Black Angels and Allies is that since 2010, we've been personally investing in startups and investing in funds. And then I would have people reach out and say, hey, I'd like to invest as well. And so we started forming syndicates. And we'll talk a little bit more about syndicates and special purpose vehicles, where you can take a group of accredited investors, because usually because of that 100 rule, like if you think about it, we are a investor, i.e. limited partner in Mac Ventures. Mac Ventures closed on $110 million. That means if you and I had $50,000 or $100,000 checks, more than likely, even though they would love to have us in to have the diversification of the cap table, they couldn't, because they would lose one of their slots, and they wanted to close on the size. And so funds started allowing syndicates. Like we would create a $500,000 syndicate or $1 million syndicate where everyone still had to be accredited, but it was like a special purpose vehicle specifically to invest in the fund. We're now embarking upon that journey with Bridget Chisholm and Marcia Bowden and links to set up syndicates in affiliation with chapters, right? You might not have one person that can write, you know, a $50,000 or $100,000 check, but that syndicate could come together, and that syndicate would represent as an entity one position. So there's some creativity in terms of how you use syndicates and special purpose vehicles to also provide accredited investors who may not have, you know, high 6 and 7 figure liquidity access to this asset class. And so we technically formed 100 Black Angels Fund 1 in 2019, and fundraising was very, very slow. And someone would say, well, you've got a track record, not just as a founder, but as an investor, an ecosystem builder. You have a lot of networks and relationships, and you do business with Steve Case, you do business with Brad Fell, you do business with Tim Draper. Like, I got the coast and the middle of the country covered. Okay, we've worked 20 plus years to get there. But if I want Black LPs, because of the data around wealth creation in this asset class, and also to have a voice, when you invest in a fund, you have a voice, and when you invest in founders, you have a voice. Who do founders respond to? Their customers and their investors. Mm-hmm. So if I want to have a call with a founder to talk about, hey, how do we increase the diversity of your staff? I'm going to get that call. So my check gives me access. And so there's a mission to the money versus just only trying to get the return. Because what I know, remember, 60% of net new jobs are coming from these high growth companies. How do I get my community upskilled and working at these high growth companies? Now that's my mission. And that's the mission of 100 Black Angels. And so last year, after the murders of George Floyd and Ahmaud Arbery and Breonna Taylor and others, I started writing and venting, and Brad Fell was one of the first persons to reach out. And, Brad is iconic investor and entrepreneur, startup ecosystem builder. He's co-founder of Techstars, co-founder of Foundry Group. And so Brad reached out and basically said, look, I got my checkbook. I'm willing to listen. Tell me what I need to do. And so Brad has since become a limited partner in our fund, and he's brought one of his partners, Seth Levine, and Dr. Charles Easley out of Stanford reached out about investing as well, and we're looking to bring him on. So allies started reaching out, and what we said was, we're creating a safe space for Black investors. We'll invite you, but you got to be committed to racial equity. I need you to do some work. And so Brad and his partners have been putting in the work around DAIS, around racial equity. Everyone in his firm, Foundry Group, took the racial equity pledge. Imagine if every VC took that pledge and every LP took that pledge, which we're going to rebrand it as DAIS. And that's one of the things we hope to accomplish as a part of these certs, because just pledging sometimes gets people off the sidelines and gets people thinking. And so since then, Fund 1, Vickie, is a small fund. It's a $5 million fund. And again, people were like, why aren't you doing a $500 million fund or at least 50? And I was like, we'll get there. But if I do that, I won't have that many Black investors. And I want Black people, Black institutions. I'm talking to Black churches. I'm talking to Black social organizations and service organizations. Like the Links made an investment as well. The minimum investment is $50,000. So 5 million divided by 100 is how we got to that number. And that's Fund 1. Fund 2 will be much larger, and we're going to do something to incentivize the investors in Fund 1 to be a part of Fund 2.
Awesome. So, okay, so we talked about the investor piece, love all of that.
Yeah.
One of the things that, I hear from VCs, and these are VCs who are run by primarily white men, is, well, we're just not seeing the deal flow. And you and I have talked on many occasions about how there are a lot of amazing Black and brown founders out there, but it's like the networks are not intersecting. And so, one of the things in the investor certificate and the workshops that we'll do there is, how do you not only tap into deal flow, but also how do you make sure that you will be viewed as an ally to a Black and brown founder? Can you talk a little bit about, not only the investment side, but also the founder side?
Absolutely. So, for would-be ally accomplices or even co-conspirators, Brad and I sort of kind of have this, definitions. An ally is like, woohoo, I support, hashtag, great. An accomplice is like, here's my checkbook, I want to be involved. And a co-conspirator is like, what can we create together to change and disrupt? And they have different levels of commitment. One of the things and that's why I think that the history of Black people in America should be taught. And because when you've heard this in motivational circles or even spiritual circles, that if you can't envision it, you can't manifest it, or you can't see it, right? If you haven't been exposed to it. So if you live in sort of a homogenous community and world, and you haven't been exposed, to, the amazing entrepreneurial prowess of like a Lonnie Johnson or Janice Bryan Howroyd or Savitri Wilson or Jasmine Crowe, or Paul Judge or Brian Braking or Arlen Hamilton or Davion Ross, or, Reapley's founder. Like, I'm just like,
yeah.
Black founders that like I see. So like, for instance, if you take an approach, which in a lot of communities, this was taught, like, to be politically correct was to be colorblind. They just didn't talk to Black people when they came up with that political correctness, because there's no way, if you're colorblind, you don't see us. And so we encourage people to be color brave. And if you think about it, the whole concept of being colorblind translates, because if someone is like, I don't see color, but then why is your firm 100% white? Like, you don't see color, like, why is it 100% white? And it's like, oh, you don't have the networks. Well, we know we don't have the social networks per se. And if we do have social networks, tokenism is not, kind of density, have like, oh, I got a Black friend, oh, I got a Black partner, we got, a Black person at our company. Like, that's 1 out of 44 million. Right. So I think once we start having these honest conversations about, how you should approach race and racism in America. And we're now I'm looking at it, very, very interesting. Whereas there's like this clampdown that basically white parents don't want their children to know about America's history, and up until this point. And, as a Black parent and as a father, I do not have that privilege, because my children, we got rid of TVs in our house after Trayvon Martin. My children happened to be watching TV and saw the breaking news around Trayvon Martin. So I had to have conversations earlier in my household, and maybe I wanted to, right? But also we have always celebrated, a lot of us, not everyone, have celebrated Juneteenth and have really celebrated Black History Month. And if you went to a predominantly Black high school, all you had to celebrate were Black people. And so a lot of times, and so we do have that depth. We haven't done that in terms of innovators and entrepreneurs. And that's something that, as a part of OHUB's entrepreneurial curriculum, is, as founders want to build forward, we want to make sure they understand the history, even how policy impacted Black entrepreneurialism in America. So because we don't have that context, but, to give you a quick cheat sheet, if you got money and you want to get it to Black founders, you basically figure out a way to incentivize and work with Black ecosystem builders. And Black ecosystem builders, we're the folks that own the co-working spaces and the tech hubs and the entrepreneurship centers. We run the one-day startup events or the pre-accelerators or the accelerators. And the reason why we don't respond to a lot of your emails is because you're always asking for free work. You're like, hey, if you know any founders, we'd love to have more, blah, 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 please send them my way. And we're like, we're busy trying to raise money to keep our doors open. You want our founders. So we've got to create models around scouting programs and venture partner programs. I'm having some conversations with some VCs now to look at allocating carry long-term to Black ecosystem builders and entrepreneurship support programs so they can operate, but also be incentivized. If we're creating your funnel of founders, then we should participate in the wealth creation versus begging for scraps or just excited to be in the room drinking a, what is it called, LaCroix with you, So, so one is that connect with Black ecosystem builders and figure out a way to incentivize us. The second thing is invest in Black fund managers, invest in 100 Black angels, invest in Lightship Capital, invest in Backstage Capital, Mac Ventures, where they're closed, so you have to wait to fund 3. Impact America. There's a good group, Fearless Fund. They're emerging. Zeal Capital. Like there are funds that are focused on investing and cultivating high growth companies as a part of the asset class. And then you'll in these types of conversations, you'll always get the conversation around, does venture capital always have to go to high growth? Why isn't there venture capital for, my florist and my Main Street business or my service-based company? And it's like, I understand why folks ask the questions because they don't understand the asset class. And so in this asset class, this fuel or rocket fuel chases high growth companies because of the expected, not guaranteed, but the expected returns that we want to see. We also, because of the Jobs Act and equity crowdfunding, as I said earlier, we're seeing new emergent types of investment theses being developed around other types of businesses that might not seek the same returns. And that's absolutely what we must have as well.
Well, and so this also touches on, so you've talked a little bit about there are other things other than VC. And I think that's important to remember when it comes to some of those other businesses that may just not be suitable for VC, but there's other elements, right? So if we got a question from Trevor Nelson in the audience that talked about, what if you're a non-accredited investor? How about recent grads? And as far as part of that is probably getting involved in the startup ecosystem, like working for a startup, being involved with an ecosystem, and also educating yourself. Because part of this, I think all of us can use more education around whether it's how do you sort of set a path for yourself to be an accredited investor one day, right? Be working for a startup, getting options, those types of things. You do a lot of stuff in the tech ecosystem around placements as well for Black and brown young men and women in the tech ecosystem, right? So can you talk to maybe some younger members of our audience and talk to them about how do they sort of set a path towards this?
I often think about the time value of money. So when we start really defining what wealth is, and how, you juxtapose wealth to the basic definition of assets minus liabilities, but at the same time, defining wealth as sort of like that economic freedom to pursue your passions and not have to worry about not having your basic needs met and being able to pass on something to your children's children, right? That's when we talk about legacy and what, kind of wealth. So wealth is defined differently for different people. Now, my advice to this generation that's coming out of, college or, boot camps or whatever your choice of training is, your goal should be to go work and get on the cap table of a high growth company. You may not be able to invest in that company today, but you can work. And when you go work, you have to negotiate for some equity. And a lot of companies are intentional about mentioning that up front, but you have to ask. And, one thing that's interesting about the startup ecosystem in particular, the high growth ecosystem, is it's really stealth, to be honest with you. You don't hear about most companies until they go public, or until they get acquired, or unless you work for them. And that's why I believe the power of innovation districts that are being built, the power of entrepreneurship centers on college campuses. You literally could stumble into something, being proximity is privilege in the ecosystem, right? And so when you attend a UNC Chapel Hill, and you have access to the Eship Center. All colleges don't have Eship centers. They should. When you go to a Georgia Tech and they have an ATDC, and then they have a Create X program, because alum have come back and said, we want to cultivate startup entrepreneurship. A challenge we have in our community is that there's this, this pull towards, you're always talking about tech. You're always talking about tech startups. And I'm like, okay, great. We don't have to just talk about that, but show me another way for people to close their personal wealth gap and not have to work 30 years or 20 years to do it. How can you do it in 10 years? And if you're going to take a bet and work right out of college where you don't have a lot of, liabilities outside of your student loans, which y'all know is a liability, you might as well use those early years working at riskier companies. They may fail, they may succeed, but if they do succeed, you'll create more wealth with the acquisition and or the IPO. I often tell this story. I knew people who had in one hand an offer to go to Microsoft, and I knew people who had an offer in one hand to go to GitHub. And the reason some chose Microsoft was because they could brag on it at the cookout. They could go to homecoming and say, oh, where do you work? I work at Microsoft. Oh, I am in Seattle making $120,000, which if you know the cost of living in Seattle, you might as well be making 45 in Chattanooga, right? So, or 45 in Atlanta, rather. 45 in Chattanooga might go a little bit further than 45 in Atlanta. But because they don't teach cost of living in your undergraduate courses, you take the job. But the person who went to GitHub, when they used to go to the cookout or church, or where do you work at? GitHub? Never heard of that. What is that? What is she doing? What is she working? Well, when GitHub got acquired by Microsoft, I knew some members of their Black Cats, which is their Black ERG group, that became millionaires. I know one particular person who said, I didn't become a millionaire, but my daughter's college is paid for, her graduate school is paid for, and I have the money to buy a house outright. And so I think, that's why it's important for our educational institutions. That's why we have the OHUB Campus Initiative, is to introduce people to this ecosystem so they can make a choice rather than just driving Black and brown folks to old industrial economies, because those old economies want to hold on to their power and their privilege. As a community, we need to be driving Black and brown folks. If it's about closing or narrowing the racial wealth gap, right now they're saying we won't close it for another 228 years. And that's if we do everything right. And we're definitely not doing everything right. It's projected to be zero by 2053. So, learning this now, Trevor, learning this now is incredibly important. And what I tend to do is, there's often this adage that you can't put new wine in old skins. And we got a lot of old skins that are proximate to the ecosystem that are doing disjustice to young people before they can make their minds up, right? I think you should be exposed to all of the opportunities, and young people should be able to make their minds up if they want to be in this respective ecosystem. And whatever your definition of wealth is, so be it. It should be enough so that you don't have to exist in poverty and that your family does not have to start over every generation. And I think that's what's happening. And because people have worked 10, 20, 30 years and have not achieved that, let us not withhold that from the younger generations. Let us not, kind of anesthetize their potential there as well. And I know we've got 10 minutes left. I also want to talk a little bit, Vickie, about why we are working to get the links invested and train and other organizations, talking to the D9 organizations and talking to HBCUs and institutions about this asset class. If you look at the diversification of your portfolio, you should have venture, if you can, and startups, you definitely can, even through equity crowdfunding and other methodologies. You should have that as part of your asset class. And then, I talk to a lot of more mature, older entrepreneurs who have built large businesses, and they're like, well, equity wasn't an opportunity for me. And debt, they told us to pursue debt. And we see a lot of debt funds popping up with the brand of racial equity. But this is me on my philosophical soapbox. Why do we go to socially disadvantaged and poor communities and offer a debt product that requires people to take the little wealth they are accumulating through their homes and automobiles and other things, which is a non-appreciating asset? But, I've even taken issue with a lot of CDFIs that require you to put up personal guarantees. So why do we go to poor communities with personal guarantees when you got a whole ecosystem of $156 billion a year that is non-recourse capital? I mean, as an investor, I have to be honest. If your company fails, I don't come like the boogeyman taking your assets. I'm not like a bank or CDFI, and I know that there are conversations about making debt more equitable, but I'm always fathomed with philanthropy when they try to create products for poorer communities that put them further in debt and they ignore equity. Maybe there's an equity product stack that is not high growth that should be created. But I think, one, philanthropy should be, net sum zero gain at worst and not be in the lending business. But anyway, I'll have that conversation another day. The reason we're doing the certificate program is to help allies find their way into this investment class, specifically around the Black technology. And this certificate is very specific, not to explore all of the investment classes, but specifically around Black tech, startup, and venture, because of all of the things that we've been talking about. We want to get more allies, capital to work, and we want to show them how to do that. And then we want to teach Black people who have the net worth how to invest in this asset class as a part of their portfolio. So we're going to teach them, I talked to some very sophisticated Black and brown folks who've never seen an investment prospectus. They've never seen a term sheet from a venture fund. They don't know what an investor questionnaire is. They don't know what it means to be accredited. They don't know how to diligence a deal. They don't know how to structure a deal. They don't understand how to operate with securities lawyers versus other types of lawyers. And so once we are educated in this space, even if you look at it like a game, right? Every game that Black people in this country have been allowed to play, we win at it.
Yeah.
We win just like our other white and non-Black counterparts win. And so we want to teach Black people how to win in this asset class. Yes, it's more risky. Yes, we tell everyone, you invest in this asset class, what you're prepared to lose because of the risk. There are no guarantees, but this asset class continues to outperform and overperform. And it's also mission critical. If we want to have influence in these early stage companies, it's important, whether that's around procurement, whether that's around hiring, whether that's around governance. Investors are able to pick up the phone and say, I think you ought to consider someone Black for your board, right? I think you ought to consider spending more money with Black and brown folks. So who do large companies listen to who? Their shareholders.
Yeah.
Not so much the people on the street protesting. They may pay attention to that and they may donate to that, but they're listening to their shareholders. So when we become shareholders in companies, and I think the opportunity for us to become shareholders, whether it's through venture fund investing, crowdfunding, direct investments, or syndicates, when I can say 16,000 Black women in the links are investing in 100 Black Angels, but they're also investing in other startups, not only do you want the investment capital, but you want 16,000 consumers. Yeah. You want 16,000 people who can say, we as an organization invested there. So that's why we are doing this. And hopefully some of you will join us on that journey.
That's awesome. Yeah, you made two really good points there that I just want to highlight. One is that by getting involved, you these are levers, really large levers to start to close the wealth gap, not only for the investor, but also for the founder who is going to have that company that takes off, right? Because then they have generational wealth that they can pass down to their own family, but also invest in more startups, right? So that lever is really important. The second thing that I just want to put a point on is this is not about, giving someone a seat at the table. It's about having a voice and about having a sphere of influence in a very meaningful way that change can be created from the inside out, right? Because, when you've talked about, how do you look at your supply chain? How do you look at your board? How do you look at where you're spending your marketing dollars? Where's your product development? Those decisions are made from the top, but are ultimately, they have to be held accountable in the boardroom, right? And so if you're a shareholder and things like that, that's where you have that influence. So as we're kind of, as we're winding down here, we're getting close to two. So what someone has asked if the course is offered on demand, that is something that we can explore and take into account. We're in the process of figuring out our schedules and stuff like that. So if you're on this email, we'll be sending a feedback survey. So we'd love for you to give us that feedback so we can really shape. But Rodney, I would love for you to just, as we're closing out here, can you tell me what the future looks like as it relates to, we'll be running this course, hopefully fall, spring, getting a
Sure.
lot of people in there, basically releasing a lot more money into black and brown founders and businesses. So what does the world look like in 5 years? What looks different in 5 or 10?
I was having this conversation with HRNA advisors, and they put out a report. Found the report because I'll drop it before we jump off, and they talked about how mirroring. Here it is. Great. I want to make sure y'all see this. So HRNA advisors are the primary one of the leading consultants and advisors to innovation districts in the country. Some of their partners were responsible for creating the research triangle in where you all are. And so they put out a report that basically says, if you look at the US economy, if you mirror the US economy, there should be 1.1 million more Black and brown folks in the technology ecosystem, okay? And of the Black and brown folks that are in the ecosystem, most of them are in lower roles like call centers or support roles versus sales, engineering. They're in blue collar versus white collar jobs. Great, honest work, we get it. So if you take that same thesis over to startups and capital, and I was having this conversation actually with Brad Feld and Seth Levine at Foundry, is if 11,000 firms, got 100 and let's say $50 billion, what I want to see in 5 to 10 years, I want to see 30% or more of that capital go to Black and brown founders and fund managers, right? I mean, I want to set a goal. So that's like 3,000-4,000 Black and brown founders that would get funded annually. And that brings us, that's just kind of, data parity, right? I'm not suggesting that will close the racial wealth gap, but because we know the data shows that investing in high growth companies creates more jobs and creates more wealth a little faster than Main Street or service-based companies, then theoretically we could narrow quicker. It's got to be done, and it's got to be studied, and it's got to be output. And I actually want to see this money go to Black fund managers and Black founders. Oftentimes we do see money that goes for our community, but it's going to people that are not from our community. And I would like to see less opportunists, and folks joining forces with Black and brown folks to help them across the finish line. I think people get excited and they want to use their networks or what have you. And then there are Black and brown people who've been doing this work that get overlooked. So, I'm kind of haven't really been looking 5 years out, kind of 20 years out. Yeah. And if we can get 1.1 million more Black and brown folks in the technology workforce, that would be amazing. The jobs are already there. And I think we just got to point people. The pipeline is there as well, whether people move lateral from the job they're in over, or they're coming out of school, coming out of boot camp, technical college, or however, going into these roles. And I want them to go into more roles than just call centers. That's why I'm overcritical when I hear about initiatives to close the income gap and the racial gap. And it's like $50 million and you're training for customer service roles. Come on, y'all. They're going to automate those away soon. You already hear automated systems. And so I think a lot of this stuff becomes performative practice. And we don't want to see that. So we want to see that on one side. And on the other side, I'd love to see where it gets to the point where it's not even a thing to announce that a Black founder raised 1 million, 5 million, or 10 million. Because when 3,000 to 4,000 of us are doing it, it just becomes the thing, right? And what we will see, because McKinsey data shows that when you trust Black and brown people with money, your economic output is 35% more. Yep. Just like when you trust women with money, it shows it's 15% more. So if we trust Black and brown women, it should be 45%, right? So if I'm an LP I want my LP like, what's your day of strategy? Because if you have a day of strategy or a solution around investing in Black and brown founders and women that happen to be Black and brown, the data shows that we return more. And so it should be you should have a fiduciary to your investors or shareholders, right? Yep. And so that's how I would like to think of it. I would like to see DAIS kind of standardized, just like product market fit. When founders are pitching investors and they're talking about their CAC, their product market fit, their traction, they're like, oh, let me tell you about our DAIS. This is what we plan to do. We're already doing blah, 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 right? And it becomes a standardized methodology that's embedded into company building.
That's awesome. Yep. So putting a point on that, investing in a diverse set of founders and Black and brown founders, it's good business. Not only is it the right thing to do, but it's good business. And the goal that you put out there, 30% of VC funding going to Black and brown founders, that is 10 times what it is today because it's 3%. So I would love to see that, and all of us can help be a part of that, right? So Rodney, thank you so very much for your time today. Thank you, audience. It was great to have you here listening to this conversation. And Rodney, thanks so much for your partnership too. We're very excited to be aligned with you on this and to help close that gap.
Absolutely. Thank you so much. Hope to see all of you in the fall.
Yeah. Thanks.
Thank you.